The US just struck Iranian nuclear sites. The dollar reacted, but gold and stocks barely moved. That's not a coincidence, it's complacency. In this video, I'll show you why that silence might be the loudest warning yet. Some say it means the escalation doesn't matter. I say it's the calm before the storm. The market isn't ignoring the risk, it's whispering before the chaos begins. Let's dive into this. Over the weekend, the US struck Iranian nuclear facilities. At the same time, the parliament in Iran has reached a conclusion that the Strait of Hormuz should be closed, even though that final decision has not yet been made by the Supreme National Council. Now, when we look at the probabilities, right now the poly markets are showing a 31% chance that this Strait of Hormuz gets closed here before July, which is essentially this week. Now, that is a 1 in 3 chance that it happens here on a very short-term basis. Right now, we just saw 2 major super tankers U-turn in the Strait of Hormuz to actually leave the area before there is any closure. So there is a clear escalation in the circumstances. But yet, when we look here at the S&P 500, it is flat today, not a reaction. You take a look at crude oil, it's flat today, not a reaction. You look at gold, flat today, not a reaction. No one seems to be worried about this, but yet the escalation is happening. The one thing that we know is that investors only start to care when everyone starts to care. We have a complete complacency, and everyone at this point is suggesting that, well, this escalation isn't going to impact the markets. Now, we have couple major things. First of all, there is a huge flows influence on the S&P 500 this week from what is known as the JP Morgan options whale. This is essentially a huge fund that does options collars out on a quarterly basis, in this case to the June 30th strike, using options to collar $20 billion of S&P exposure. This options flow gamma is actually pinning this market into a tight trade range. In fact, we can very easily see the S&P gravitate toward 5,900 this week. The question is this kind of options flow enough to keep the market stable this week, or do things wake up? The one thing that I want to highlight is that gamma is a lot like a gravitational pull of a planet, and we have right now this the market stuck in this gravitational pull in the markets, and it's going to create this pinning. But if a trigger comes in this week that forces that to break out of that gravitational pull, then we could have substantial volatility kick in. Is it what you should expect this week? Well, it's quite irrelevant on the very short term. The volatility, I think, will come whether it comes after this week or this week. There is going to be market volatility. This complacency is not going to stay. So let's go through these charts. The S&P 500 recovering in the overnight market. What I want to highlight is that you can observe that a 61% retracement lies at the 5,900 strike, right at the sweet spot of where that gamma sits on the S&P 500 options markets from that JP Morgan whale. Odds here that we start weakening this market just a few points this week toward that center point is the path of least resistance. The bigger question, what would it look like if this market correction really kicked in? Well, look at this. We basically had a 70-day, just over 2 months, 26%, almost 1,300 S&P point rally from trough to peak. We are overdue for corrections. This is not even an issue of some doomsday scenario. Every market corrects when you have such a huge move. The question is what would a normal correction be? Well, observe here that even a 50% retracement to 5,500 of this move would result from a peak to trough correction of about 10% or 600 S&P points. That's enough to give a few people some ulcers. The question is that does this kick in now? Is the market too complacent? Well, even if this week the market was pinned towards 5,900, once all of that gamma rolls off over the weekend, the market is going to be in a position to start buzzing. And this is something you should not ignore. This is a fabulous opportunity in this lower vol environment to put on a whole series of portfolio hedges, raise some cash, and particularly deleverage a huge amount of let's say leverage that you may have open in your stock markets portfolios. So let's talk though about what is moving. The dollar is moving. We have it up 50 cents today. Where is that move coming from? Well, let's break it down. First of all, we were all along calling that the likelihood of a breakdown to 95 was not our favored scenario, and that more than likely the dollar remaining in a trade range with it rallying back to the highs of May near 101, 102 was the path of least resistance. We clearly now have something that resembles a double bottom test and a breakout that if it beats the 100 level where that 50-day moving average is, we're going to have a dollar rally. Nobody's ready for this. Everyone's bearish the dollar. Everyone's looking for the dollar to go weaker. There is lots of room for the dollar to be squeezed the other way. Now, again, that doesn't make me super bullish the dollar. We're talking about flows, a short-term trading opportunity where if enough traders are on the wrong side of a trade, it creates these violent reactions the other way. I will not be shocked here if we put on a 1 to 3 point handle move on the upside of the Dixie, but let's analyze where it's coming from. First of all, the euro a little bit weakening off of its high, but the real move is not in the pound sterling, it's not in the euro, it's in the US dollar yen. Look at the way this move happened. So we went from 160 down to about 140 on the downside of the US dollar yen. Now, after retesting the lows and not making lower lows, we have a scenario where we are now closing above the 50-day moving average, and this descending trend line has been broken. So this downtrend that's lasted almost 6 months in the US dollar yen is reversing. This is a clear indication that this is a pivot in dollar positioning. Similarly, for instance, the US dollar against the Canadian dollar, an extraordinary kind of Eiffel Tower formation where we had a huge rip in the election window and then a huge reversion. But we've now retested a major support line. The US dollar CAD has now actually come and is quite oversold, ready for a reaction. So for us to now get counter trend moves where the US CAD goes to 140, 142, these are all on the table 100% for the next currency move. Watch this dollar for it to have almost like a safe haven rally here. Now let's talk gold. Now this is the interesting part, because usually during US dollar rallies, typically gold has some distribution. I don't want to imply that it has to be something more ominous, but yet the price action in gold continues to actually be quite positive. So far, this entire pullback for a week has held above every Fibonacci zone. It's held above the 50-day moving average. This little flagging formation can very quickly bullishly blast off still, and all kind of measured moves are 36 to 3,700 for the first impulse, and even moves to 38, 3,900 as continuation patterns. The only obstacle is really its previous highs. You have the previous highs. Some people want to speculate that this could be a double top. I just don't buy that in this kind of geopolitical environment where we continue to see there be distrust and diversification out of the U.S. Gold continues to be a very important asset. I could see this easily still breaking out. The key for me is that I'm going to remain decisively bullish so long as we stay above that 3,300 level. That's a fib retracement, 50-day moving average. All pullbacks should be bought on dip in this environment. That's no different on silver. Silver here, you can observe, is retracing, but not yet even come to the 35 level where its fib retracement zones are. To me, these are all levels that can continue to be bought on dip for bull continuation. Even here, like if we take platinum, all dips are being bought. Palladium, look at this breakout candle. Don't ignore this. This is a consolidation pattern with a potential breakout. While gold is not getting the love yet on the upside, these other precious metals are still setting up for continuation patterns. There's an opportunity here. Don't ignore it. So the question then becomes oil. Now, oil had this pop and drop that is a little odd, because you would believe that this type of escalation should sustain higher oil prices, yet once the oil pops, like jumping to $78 in the overnight session, immediately fades down to 73. What's suppressing this? Is there still that big upside? Well, clearly, listen, if there's any sustained closure of the Strait of Hormuz, which again is about a 31% odds right now that it happens this week, you have a scenario where we could have $100 to even $120 Brent crude price. This can't be ignored. Yet right now the market is just trying to figure things out. It's not the easiest trade at this moment, but the way I look at this here is that if you want to put on an oil trade, it is now better to be playing it with energy stocks. Energy stocks have been beaten down, left behind, and now if there's further escalation, it will bring the theme of the need to have energy independence, which is going to then once again highlight the need to keep pumping oil in places outside of the Middle East. It should wake up the energy markets. I think there's plenty of opportunity still to make money in the energy space. Finally, I just want to touch on interest rates. What we can observe here is that I'm just going to start with the December 2026 SOFR. We can observe that it continues to strengthen a little bit. Will we see the market start to price in more Fed rate cuts? I'm totally on board with this. One of my favorite trades out there to continue to play a bull breakout in this space. Now, when we even look at the long bond, the 30-year U.S. Treasury, trying to get above this 50-day moving average and trying to actually break this pattern of lower highs and lower lows. This is the key level to watch here on that future, is the 115 level on the TLT. That's going to be somewhere around the 97 level, or 87 level. Let me just quickly see what the level is on the TLT. Yeah, around the $87 to $88 level. We look at a 50-day moving average right there at the 87 spot area. The point being here, as a bull breakout above this area will pivot this long bond. Are we going to see this? These are the little puzzles we're going to solve. We're going to be giving you updates all week long. Have a good trading day, everyone.